Now, I also want to point out that the structure that Steve laid out is technically a commercial mortgage-backed security in a REIT structure. And what ends up happening over time is they do about 10 of those things, and then they sell them into a conduit, like a SunTrust, and then David buys them in his portfolio. So with that, on my first question for Martin, I haven't seen any structured product in your portfolios. Is that a place where you're going to go?
We do have some structured product exposure. I think as the funds grow in size, it's something that we're certainly interested in, exploring and adding. And, sometimes on the commercial mortgage-backed side, we don't, when you have hospitality loans in there, for example, a lot of times they get kicked out because of, in-room pornography or other types of exposure. So it can be challenging sometimes on the commercial side when you're looking at lots of different loans pooled together. You've really got to try and find pools, but industrial and office, certainly no problem. We do have some exposure, but you're right, it hasn't been significant.
Well, and I wanted to point out that we were ready to dismiss Steve's fund, but they are very transparent in the holdings, and there was a hospitality in there, but I think it was a Holiday Inn Express. So for everybody's screening, and it actually happened to be in Vegas. So when we saw hospitality in Vegas, our antenna went up, but again, I think it's a Holiday Inn or something, right?
So it's a Fairfield Inn 6 miles from the Strip. No bar, no casino.
So my next question for Walt is, so there's been no defaults in your long history, but there's obviously defaults due to these litigation. What is the protection of bondholders with litigation? What have you seen so far?
Sure. So you're right. We've been very fortunate. We've had no defaults in our 86 years of doing this Catholic business. So I'm keenly aware that could change Monday when I get back to the office, but so far so good. We are very careful when we do our underwriting. So we make sure that the protections include upfront due diligence. I visit the site, I meet with the pastors, I go to the diocesan offices, we look at financials, all the things that one might do in terms of due diligence, and then we try and create structures that are appropriate for the transaction. So it could be a general obligation guarantee of the diocese, it could be a first mortgage on the property, it could be both. So we try and make the collateral match the risk, and like I said, thus far we've been pretty lucky in terms of that risk has not come back to harm us.
So now this question for David, and I'm not sure if Martha's still here from Parametric, but everybody who's been trained quantitatively knows that when you start generating a positive information ratio trade of 3% volatility and 6%, it's not sustainable. And there tends to be sort of a 3 or 4 standard deviation event. So while you've had great success catching the bottom off of the 2008 environment, what's the risk of this happening again, and where is your multi-strategy portfolio vulnerable?
Yeah, no, great question. If you look at the mortgage market in general, we're still in a first inning of a mortgage rebound from a credit aspect in the United States. So these legacy securities, while they did have problems in the past, those problems have happened. And as I mentioned earlier, what you're left with now in the legacy space is borrowers who have continued to make their payments and continue to get better every day. The average LTV in the legacy portfolios we have now is a 60% LTV, which means these borrowers now have 40% equity. They've been making 11 to 15 years worth of payments. It's not like it was 10 years ago where they could just walk away. They had no equity, they just bought a house, they were over levered, and they could just walk away from the property. Now there's real skin in the game. So from a default from the legacy side, we don't see that as a big of an issue, as again, these borrowers have built up equity and real estate's on a much stronger footing. Moving forward, from mortgage credit side, as I mentioned, mortgage credit and lending on the residential side has collapsed. From commercial real estate, we're invested in some commercial real estate as well. Lending has happened in commercial real estate because banks were willing to lend to those commercial properties. Not to mention private firms such as Steve's can lend as well. From the residential side, the banks are punished to lend to borrowers that they traditionally lent to. So mortgage credit has contracted in the United States, and as anybody in here who's tried to get a mortgage recently, it's not easy. It's gotten very, very hard. And as we continue to grow, and as the market continues to expand, you're going to see that non-agency lending pick up, but it's going to be driven by the private side. And as this new agency lending has been coming out, the rules and regulations have changed dramatically. From an appraisal process standpoint, the rules have completely changed, where the person who was in charge of the appraisal process was also in charge of originating the loans. That's no longer the case anymore. Not to mention the approvals that you have to go through to prove that the borrower has the ability to repay. You can't put them in teaser rates and so forth and to qualify for a mortgage. And so there's a lot more risk to the originator than there was ever before, and so there's a lot more safety within that marketplace. And as it's still, from a mortgage credit standpoint, if you look, there was $1.5 trillion in non-agency mortgage creation in 2006. There was $1.5 trillion of non-agency mortgage creation in 2007. Today, last year, there was maybe $10 billion in non-agency mortgage creation in the United States. This year is probably more like 20 to 30 billion. That market, if you go back to 2000, 99, 98, was a $100 to $200 billion marketplace. And that's where it'll probably shake out into the future, and that's what we expect moving forward.
So has a lot of this risk been shifted to the agencies?
A lot of the risk, well, the agencies are doing right now roughly about 80 to 90% of mortgage origination in the United States. I would say no, because even there, if you look at what's been originated on the mortgage market is flat for the last 10 years. The size of the mortgage market outstanding in America has not grown from a residential standpoint in the last 10 years. Where everything else has continued to grow is America's continued to grow. The population in America hasn't gotten smaller, yet the mortgage credit outstanding is the same place it was 10 years ago.
And LTVs are higher too.
And LTVs are higher. Currently, Americans are sitting over, it's roughly around $6 trillion in equity in their homes, which is the largest amount of equity ever been assembled within residential real estate, because borrowers simply can't tap the equity in their houses like they could in the past.
Right. So, Martin, there's a lot of structured product, mortgage, but your multi-asset income fund is structured very different. Can you provide the allocation to your multi-asset?
Sure. So for the multi-asset income fund, it's really a go anywhere income fund where we're investing anywhere in the capital structure. So unlike some of the other vehicles here, it's not solely on the fixed income side. We can invest, so we'll find companies we like that we think are doing good things in their industry or good things in the world, and also meet all of our financial criteria. And then we will look at the capital structure, and within that fund, we're looking for income. So we can invest in straight corporate debt. We can invest in high yield corporate debt. We can invest in convertible structures, preferred stock if they have it, or common equity, but it would have to be dividend paying equity because of the mandate of the fund. So it's very flexible in terms of we find companies we like, and then we, on a risk similar to what somebody was talking about earlier, I think it was with the mortgage tranches and where you want to be, you do a risk reward assessment, and we do the same thing just on the entire capital structure of a company, and really try and get exposure where we think investors are going to do the best.
So what kind of a distribution yield do you have on that fund right now?
So the total distributions from all sources, because we do invest in things that pay, so MLPs and yield cos and other things we invest in, they really pay return of capital distribution. So I've got to be careful from a compliance reason, because we're distributing more than the yield that's reported in Morningstar, which is I think around 3.3%. But the actual distributions that investors are receiving is somewhat higher, because some of the characterization of that yield is return of capital from some of the. So somewhat of a complicated story. If anyone's interested, I can discuss with them afterwards.
Yeah, it's even worse on the mortgage side, so.
Yeah, I saw
So you're
David nodding there.
So, bad day, you told me, right? The inflation's back and the 10 years flirting with 3% again, right?
There was some good, we're finally starting to see income growth pick up and finally starting to see inflation. It's been remarkable. You've had this very long recovery, and you've seen as fixed income investors, we all have to worry about inflation, right? And that's, I think, some of the panelists had really focused on duration risk, and I think rightly so, because where I see, the 10-year is still very low by historical standards, and so is the Barclays Ag, and duration is actually fairly long. So if anyone had asked any of us, I think probably 10 years ago coming out of the crisis, you're 10 years later and the market's more than tripled, and you've got, equity markets have more than tripled, and you've got, unemployment that's at record low levels, and there are, all of these positives, and where's the 10-year going to be? I think very few people would say sub 3%. So right. I think there's still a lot of risk there. And the big wild card, what's enabled this has been just persistent low inflation and just very controlled inflation. So I think you saw yields move higher today because income, some of the wage growth numbers are finally starting to look higher than people have been expecting.
Well, we finally broken the deflationary cycle. I told a story to Nate that there are interns that are in their 20s about my start, and I started about 100 years ago on a cash management desk for an insurance company. And this was back when rates were 15%. So you can back into how old I am from that. But my job was, if I got a large payoff on a commercial mortgage and it was drawn on a California bank, at 23 years old, I got a credit card and was told to go to Wells Fargo in LA and deposit the check, and we made $100,000 on the float. And so since that day, it's been a secular decline in rates, and there's been a deflationary period. And now we're back in an inflationary period. We're struggling with it, like the previous panel talking about what are the hedges. Gold used to be, certainly the commodities. But I do think it's a very different rate environment, and I think what you're seeing from these products here is they are much less rate sensitive than credit sensitive, I would say. They're more credit focused and less duration sensitive. So you're 6.5%?
6.1.
With a little bit of duration. We got the 10-year now, let's say the 5-year at 2.5, and you're triple B spread, so you're at
4.5 to 5.
4.5, you're at 3.5, and you're kicking out like 5, right?
We're paying a little bit over 5%.
Right, so these are decent, in the context of the rate environment, I think these are very compelling opportunities. Now, Mr. Wilde, though, where do you position now the strategic income fund that's coming your way?
So what we've really looked at the history of the strategic income fund, and we're not looking to make any big shifts or any changes in the strategy there. It's really, the strategic income fund has really been primarily focused on investing in relatively shorter duration bonds. So when we looked at the fund historically, there's been some exposure to very small exposure historically to some dividend paying stocks, but I think now it's only a couple of percent if I'm not mistaken. And when you look at the allocation to really standard relatively short duration bonds, it's over 80% of the fund. Right. So we're actually changing the name to avoid some of the confusion. When people say strategic income, it can mean a lot of things to a lot of different people. In reality, that fund is mostly invested in limited term or limited duration bonds, and it's a relatively safe place to be because you don't have a lot of duration risk. But we don't, so we are planning on, as we launch and do the restructuring, instead of calling it strategic income, we'd call it the limited term bond fund. There'll still be some flexibility to. The rule is that you've got to keep over 80% in bonds that meet that criteria, but there's still the ability to add some value with some preferred stocks. And I think what the strategy is done on the preferred side, because preferreds can be, very duration sensitive and very long dated with, perpetual maturities or 30-year maturities. So I think what the portfolio manager has done, historically when they've invested in these preferred stocks, is invested in preferreds that are basically trading to a short call date. So they have a pretty high yield that they're distributing, but the market's pricing them to a very short call. So it basically makes them behave like shorter duration instruments. If interest rates really picked up a lot, there is some risk that duration would push out a little bit, but you're getting compensated then by a much higher distribution yield. So I think on the margin, things like that can add value, but at the core, we want it to be a relatively defensive fund that is focused on limited term bonds.
Right. So great minds think alike, because my last job was a product job on fixed income at Fidelity, and the last product that I launched was a limited term bond ETF. So well done. In that effort, by the way, one of the points that we use that I think is captured in all the slides that we talked about in terms of the yield versus duration component, even in the secular bull market for bonds over the last 35 years, where we've gone from literally 20% to zero over a 30-40 year period, the return of short intermediate bonds was about 95% of the return of the broad bond market, was 60% of the volatility. So if you have a backdrop, a favorable wind behind you with rates going lower, but you're still capturing the bond market with shorter duration, that should make you even more comfortable about a market going forward that could be in a rising rate environment. So with that, the motto we used to use for that fund was it tastes great, less filling. What a better way to move into the reception, right? I want to thank everybody.